Who should consider selling cash-secured puts? An investor who would like to acquire shares in a particular security, but is willing to wait for them to trade at a target price that is below current market level. Have you ever entered a limit order to buy a security at a price below its current trading level? If so, you've most likely experienced a waiting game, and possibly a lengthy one, because the stock will not be purchased until it trades at or below your limit price. Instead of simply waiting for that to happen, you could take an approach that is a little more proactive and sell, a cash-secured put. You will be paid in the form of premium received for selling the put in return for accepting the obligation to buy underlying shares if assigned and at a price lower than what you selected in advance. Many large portfolio managers, as well as individual investors, find this attractive as a means to acquire stock for their portfolios. Definition: an investor who employs a cash-secured put writes a put contract and at the same time deposits in his brokerage account the full cash amount for a possible purchase of underlying shares. The purpose of depositing this cash is to ensure that it's available should the investor be assigned on the short put position and be obligated to purchase the shares at the put strike price. While the cash is on deposit, it may generally be invested in short-term interest-bearing instruments. The net price paid for underlying shares on assignment is equal to the put strike price minus the premium received for selling the put in the first place. For this reason, the strike price chosen, less the premium amount, should reflect the investor's target price for acquiring underlying shares. Regardless of the direction the stock price takes after the put is sold or whether assignment is received or not, the put seller keeps the premium. On the downside, the break-even point for this strategy is an underlying stock price equal to the put's strike price less the premium received for selling it. If the stock declines significantly below the strike price by expiration, on assignment, the investor may be obligated to purchase shares well above their current price level. Stock bought under this circumstance may therefore reflect a loss compared to its market price at the time. However, this loss would be unrealized as long as the investor holds the shares and is positioned to profit from an increase in their price. Any investor whose motivation in writing a cash-secured put is to buy underlying stock should therefore be committed in advance to a target price for a possible purchase and select a strike price accordingly. On the upside, the risk is one of opportunity loss. After selling the put, the underlying stock price can go up and remain above the put strike price. In this case, neither a put seller who is not assigned nor an investor who originally entered a low limit order for the stock instead will buy the stock. The put seller, however, keeps the put sale premium received. An investor who would like to acquire shares in a particular security but is willing to wait for them to trade at a target price that is below current market level. Using the Greeks to understand options delta is the change in option price per unit point, change in the underlying price, and thus represents directional risk. Delta is interpreted as the hedge ratio, or alternatively, the equivalent position in the underlying security. A 100 delta position is equivalent to being long 100 shares. So an easy way to think about delta is that it can represent the probability that an option has of finishing in the money. A 40 delta option has a 40% chance of finishing in the money. At the money options tend to have a delta near 50. So think about it this way. If you buy a stock today, it has a 50% chance of going up and 50% chance of going down. In the money options typically have a delta greater than 50, and out of the money options are typically less than 50. Increasing volatility or time to expiration in general causes deltas to increase. Gamma measures the change in delta per unit point, change in the underlying security. The gamma shows how fast the delta will move if the underlying security moves a point. This is an important value to watch since it tells you how much more your directional risk increases as the underlying moves. At the money options and those close to expiration have the largest gammas. Volatility has an inverse relationship with the gamma. So as volatility increases, the gamma of the option decreases. Theta measures the change in option price per unit day, change in time, also known as time decay risk. It represents how much value an option loses as time passes. So long-term options decay at a slower rate than near-term options. Options near expiration and at the money have the highest theta. Additionally, theta has a positive relationship with volatility. So as implied, volatility increases, theta also generally increases. Vega measures the sensitivity to an option to volatility, represented as the change in option price per unit, percent, change in volatility. If an option has a vega of 0.2 and the implied volatility increases by 1%, the option value should increase by 20 cents. Options with more time till expiration will have a higher vega value compared to those nearer to expiration. At the money options are most sensitive to changes in vega. Rho represents the option's sensitivity to interest rate risk, the change in option price per unit change in interest rates. A position with a positive rho will be helped by an increase in interest rates, and a negative rho will be helped by a decrease in interest rates. Conclusion. We hope this tutorial has given you a practical view into the world of options. Options do not have to be difficult to understand once you grasp the basic concepts. Options can provide opportunities when correctly used and can be harmful when used incorrectly. Please use this tutorial as it was intended, as a starting point to learning more about options. All right, let's recap. An option is a contract giving the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. Options are derivatives because they derive their value from an underlying asset. A call gives the holder the right to buy an asset at a certain price within a specified time period. A put gives the holder the right to sell an asset at a certain price within a specified time period. There are 4 types of participants in options markets: buyers of calls, sellers of calls, buyers of puts, and sellers of puts. Buyers are often referred to as holders, and sellers also referred to as writers. The price at which an underlying stock can be purchased or sold is called the strike price. The total cost of an option is called the premium, which is determined by factors including the stock price, strike price, and time value remaining until expiration. The premium of an option increases as the chances of the option finishing in the money increases. A stock option contract typically represents 100 shares of the underlying stock. Investors use options for income, to speculate, and to hedge risk. Spreads and synthetic positions highlight the versatility of options contracts. Employee stock options are different from listed options because they are a contract between the company and the holder. Employee stock options do not involve any third parties. The 2 main classifications of options are American and European. Options can also be distinguished as listed OTC or vanilla exotic, among other classification schemes. Long-term options are known as LEAPs. Option prices are determined by the Greeks, which allow for an option's risk to be understood and evaluated. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.